Good morning, good afternoon, and good evening to all our audience who are joining this webinar remotely. Welcome to today's webinar, Career Insights on Risk Management, hosted by CFA Institute and CFA Society India. My name is Biharilal Devra, and I'm your host today, and I'll be moderator for your session. In my day job, I work with the alternative investment fund called Abacus and based in Mumbai. Before I introduce our speaker, let me talk about a little bit of housekeeping notes. Today's webinar is scheduled for about 60 minutes, including the questions and answers. We'll be leaving time for enough Q&A after the presentation, but feel free to submit your Q&A in the chat box throughout the presentation, and we'll collate that. You can also do so by clicking on the Q&A icon at the bottom of your viewer and typing your questions in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete your evaluation survey before you sign off so that we can continue to plan similar sessions in the future. Now, it's my pleasure to introduce our speaker today for today's webinar, Raghuvir Mukherji. Welcome, Raghuvir. Raghuvir is a Senior Executive Vice President and Head Risk Management and Wealth Compliance at IIFL Private Wealth. Raghuvir is the Head of Risk Management and oversees broking, depository, and wealth compliances. He looks at enterprise risk across the businesses of IIFL, including distribution, broking, lending, asset management, and trust services. He has almost 2 decades of experience spanning various domains, including commercial banking, equity research, security services, functional consulting for technology companies, and risk management with firms like Citi, HSBC, JPM, and Infosys, of which the last 9 years have been in the risk management role. He is an alumnus of St. Xavier's College, Kolkata, a chartered accountant, a certified financial risk manager accredited by GARP of USA. Thank you, Raghuvir, for joining us today, and floor is yours.
Thank you, Biharilal. It's great to be here, and thank you for giving me the opportunity to talk about risk management, something that has become my calling over the last 10 years to everybody who is attending. So without further ado, I think we'll go ahead with our presentation, and then you can ask your questions on the chat box as and when you have them, and then after the presentation, I'll attempt to answer them. One second. A little bit about risk management first, what it entails and what it means in general. So risk is basically inherent in any business. One of the reasons why there aren't more people in business is because it entails risk. I had read somewhere that I think some 50% of all don't manage to, sorry, yeah, Biharilal. Am I not audible?
Yeah, if you can switch off your video, I think your voice clarity will be a little bit better.
Yeah.
Thank you.
So risk is inherent in business. It can be defined as the possibility of divergence between plans and actual outcomes. So what I was saying was about 50% of businesses which are started don't make it to more than a year of survival. So, there is always risk in whatever business you may want to do. However, when entrepreneurs start a business, obviously they are not thinking of failure, but they want to make a success of it. So they have to be a little optimistic. And the same goes with sales managers and fund managers. The point is they have to look forward to the future, and that's how they build the business. And hence, organizations are increasingly feeling the need for somebody to tell them what can go wrong. Because if you have a whole gung-ho set of people who are looking forward to the future, there has to be somebody who says, okay, be careful, you could, there are snakes in the grass, as it were. So you have to be careful about those as you move forward. Risk has also been compared to the braking function in a car. So if sales and the CEO's office are the accelerators who are pushing forward the vehicle, then the compliance and risk functions, which tend to tell them where to stop or what the borders of the playing field are the brakes. And you can only accelerate because you are confident that the brakes will work. So I think even for the healthy development of the business, and for the senior management to have confidence that they can move forward with a sustainable model of the business, you need risk managers. The other thing that is happening in various sectors is that the pace of technological change has quickened. So, if one goes back to maybe around 1200 AD, between 1200 and 1300 AD, almost nothing would have changed for 100 years. You were still riding horses, you were lighting candles once darkness fell, you were writing, there was no printing press, okay? So you were handwriting everything. If somebody was born like in 1200 AD, he didn't, and he had a grandson born in 1300 AD or great grandson born in 1300 AD, there wouldn't be much difference in the life that they would lead. But this has changed pretty rapidly in the last 200 years. But even within the last 200 years, the pace of change has become much more rapid in the last 2-3 odd decades. See, for example, that dialed landline phone. Now, those of us who have been around long enough have seen this big black box with a dial, which was basically the phone in my childhood. And that is an instrument which more or less remained the same for about close to a century. It's about, since the beginning of the 20th century to till the year 1995 or 1990, I would say, it remained more or less the same. But now, there are new models of mobile phones which come up pretty much every year. The internal combustion engine, which is used in our cars. Now, this came up around the 1890s and has remained more or less the same with some minor changes. But as we know, that is kind of seeing the end of the beginning of the end for the internal combustion engine has started with battery operated vehicles. So I think we are going through seismic changes in technology, and the pace of change has also quickened, which means that it is difficult for people to keep up. And hence, professional risk managers can sensitize the business to changes in the environment. It's become a much more volatile and complex environment. And another complexity that has happened is the world is much more integrated now. So something that happens in America can affect markets in India. There can be, for example, a patent granted in America, which can affect technologies which are being used in India. And in fact, that is what happened, because everybody was using Nokia button phones, and then Apple came out with this new kind of technology, and very quickly the button phones went out of favor with a very large number of customers, and Nokia had to declare bankruptcy. At one point in time, if I am not mistaken, Nokia had a 50% global market share. Around the year, it would be around the year probably 2003 or 2004. And BlackBerry was pretty much, BlackBerry and Motorola were the only competitors. And then, of course, the iPhone came and completely disrupted the market. So you need professional risk managers who can keep an eye on all this complexity and on the volatility or on the dynamic volatility that has happened in various sectors, and tell the business what the warning signs are or what they should be doing so that the business is not badly affected. And the actual outcomes are not very different from what was planned or anticipated. And now Section 134 3N, which I have mentioned here, of the Companies Act also requires that the board of directors actually include a statement of how risk management is done in the company to their shareholders. So, the Companies Act recognizes that every business will have a certain amount of risk, and shareholders ought to know how that risk is getting managed. Regulators have also made it mandatory for certain organizations to appoint a chief risk officer, especially for banks and NBFCs above a certain size. I think it's 5,000 crores in assets, have to now mandatorily appoint a chief risk officer. And even for SEBI regulated entities like asset management companies, SEBI pretty much expects that there will be first of all a risk management function, and then also somebody designated as the chief risk officer who will independently report to the audit committee of the board and the CEO. So net, you now need, the need has been felt, and that is why regulators have mandated that there should be a person who is a specialist and who is specifically looking at risk management in the organization. So what does risk management entail? So by definition, it is the monitoring, measuring, and reporting of data relating to the business and its environment. So if you, it's probably not a great example, but it's the example that I can think of top of the mind. That if you think of a patient lying in a hospital, and hopefully the business is not like that, but especially in the intensive care unit, you have all these machines measuring the patient's vital signs, so that in case anything goes wrong, people can quickly take action, and save the patient. Also, there are machines which are regulating the external environment. For example, the temperature, the amount of oxygen in the room, all that stuff, because those patients are in a very delicate state of health, some of them in a very critical state of health. So risk management is kind of a similar function, where you are monitoring the vital signs, you are measuring how they are doing over time, and you are reporting this to the business so that decisions can be taken. You may be also monitoring some of the external stuff, which I've written after the asterisk. So essentially, we're talking about credit, market, operational, and external risks. I shall probably quickly explain what these are, but let's talk about the external risks first. Basically, these are things that are not peculiar to the organization. So, for example, any technological change. I spoke about the iPhone disrupting the whole Nokia story, and the way battery-operated cars are kind of threatening to disrupt the internal combustion engine. Then, of course, there is government policy. The governments across the world, for example, are pushing people towards renewable energy, battery-operated cars, less polluting industries. They are pushing people not to use and throw plastic, bags or other plastic instruments. Consumer tastes might be changing. What people liked then may not be what people like now. For example, in the 1940s, in the 1940s and 50s, the dhoti was big in Kolkata. Everybody wore dhotis in any formal function. But now it's not all that popular. So obviously, most people wear the utilitarian trouser, and the dhoti is more of a exotic thing that people wear probably during the Durga Puja or some other very special function, perhaps weddings. But of course, there are economic, indices like inflation, GDP growth, the movement of interest rates, which affect different sectors differently. For example, if interest rates go up, then people will tend to take less loans. So that affects those businesses which typically sell their products in a leveraged manner. For example, homes and cars and expensive white goods, which typically people borrow money to buy, then those those industries are affected by an increase in interest rates. It's not just banks which are affected, and of course banks and financial institutions are directly affected by interest rate changes, but I'm saying a lot of other industries are indirectly affected, and that indirect impact may be very severe. For example, if people take less home loans and they don't buy houses, the real estate sector is very badly affected. And then there is stuff like social media, etc. You can have unhappy customers now very quickly spreading the word about how a company treated them badly, etc. There are I have myself watched videos of people getting beaten up. I think that was American Airlines. In fact, a doctor got beaten up, and that created a lot of bad media for them. In India, I know that there was an untoward incident in, I think, Indigo, where again there was a bit of a scuffle with a customer between staff and customer. So these are external risks that the risk manager has to keep track of. And then there are risks which are internal to the business. And of course, not completely always, because there is always a certain amount of intersection between the external risks and what is purely internal. So, for example, credit decisions might, it's essentially your decision to lend money to someone or to finance something, but that might be dependent on how that sector is doing. For example, if somebody is working in the auto sector and the auto sector is badly affected by a recessionary trend, you may decide to withhold credit to that person because his credit worthiness is affected. Market risk is the monitoring of traded or market positions and the impact of changes in market forces which ultimately change prices. So, I spoke about, for example, interest rate changes, but you can obviously have changes in equity prices, you can have changes in derivatives, and these changes in market factors, in factors that affect the market price, can then again, you may have to take corrective action, reduce your positions, or hedge them with other positions. So, so market risk is a pretty complex area of work. And also somehow, because markets make a lot of money and things move very quickly, there is a certain amount of, what's the right word? Glamour associated with market risk management. But the fact is that credit and operational risk are equally important and have vast opportunities for employment. So, any senior risk management professional will give equal importance to all these different types of risks rather than only focus on market risk management. Talking about market risk, obviously in the fund management space, market risk monitoring is very critical. It entails independently monitoring the fund performance, the mark-to-market positions, the risk metrics like volatility, value at risk, and certain ratios like Sharpe ratio, information ratio, etc., which one might call the vital signs which I spoke about. And plus, the risk management function also independently vets the performance of the fund and breaks it up into the calls that the fund manager has taken in terms of sector allocation or stock picking, using something called a Brinson model. Operational risk is a vast space that includes risks relating to processes, people, and technology. So, all kinds of, pretty much this is a catch-all. This is the balancing figure of risk. So credit is credit, market risk is credit positions, operational risk is pretty much everything else. So it would include risk of fraud by employees, risk of fraud by customers, risk of fraud by third parties. It would include your systems going down. It could include data privacy getting violated. That can be quite embarrassing, as you might imagine. And now with these new data privacy laws, it can even bring regulatory censure. It includes having proper backups, both in terms of systems and people. It includes controls in the process by separating non-compatible functions. So one person shouldn't be able to complete the whole transaction. Then he might, at some point in time, be tempted to do a fraud. So it entails all these areas. Okay. In banks, we have the added, and to some extent in NBFCs also, you have the added aspect of what will be the impact of taking certain actions or giving certain credit on my capital adequacy ratio. So, there are, for example, market risk positions which eat up more capital compared to other positions. So where you invest can make a difference. So the net return after deducting the cost of capital may not look so attractive. So let us say, I pay 12% for my cost of capital, and if one position is taking 100 rupees of capital, though it is generating 15%, but net return is only 3%. And whereas another position is taking only 50 rupees of capital, it may generate a lower return, but still it may be profitable. So the impact of capital is also quite important in banks and financial institutions because they have capital adequacy ratio. And that is something that often there is a separate dedicated risk management team. In HSBC, we used to call it the risk strategy team, which looks at this area. This is relating to the Basel rules of capital adequacy, which are adopted by various central banks and implemented in the various banks and financial institutions. Whatever area of risk management you may be in, so whether it be credit, market, or operational risk, ultimately risk management entails a lot of attention to detail. You are supposed to understand things or notice things which others wouldn't. For example, a trend or a correlation, which maybe others would even miss, but that is something that a risk manager would catch. You're the last line of defense. So, so this is something that I put a lot of importance on when we recruit young people for risk management, for the risk management function. That are you okay with going through sheets and sheets of Excel sheets, doing sorting or filtering, and are you okay with that kind of analytical work? Because if you're somebody who likes meeting people, talking, then you should go into sales. If you like quickly doing a lot of stuff, you are very well organized, then operations is your game. Okay. If you so risk management is, let's face it, it's kind of quiet analysis. A lot of it is thinking and then deciding what to do or recommending a decision on what to do. Typically, you are never taking the decision. You are recommending to other people what to do. Should you give that money or not? Should you invest into that product or that instrument or not? Should you exit that instrument now? Is there some negative news about this particular customer? Is that customer very risky from the money laundering perspective? So all that kind of thing, all that recommendation, and some of that might actually be veto power. So your recommendation might carry, you have to say a yes if the organization is to go ahead. So in many places, I have that role, which is a gatekeeper role. You would need to be a gatekeeper, like any chowkidar that you can think of in your building, etc. You have to be very careful about what is passing through. you have to keep your eyes and ears open. And so, in fact, to digress a little bit, the Institute of Chartered Accountants of India goes with the motto, Ya Eshu Supteshu Jagarti, which is he who is awake among those who sleep. So it kind of brings forth the sentinel function of an auditor or a chartered accountant. And a risk manager has a very similar sentinel function, a guard dog kind of thing. Of late, big data analytics are being used in credit appraisals, market risk monitoring, and fraud identification. So essentially, for example, people are, conventionally people looked at your salary slip, at your, where you were working, that kind of thing. But now people also look at other stuff because they realize that you can easily, produce a fraudulent salary slip. So they look at things like, for example, what is your credit score? Are you always maxing out your credit card? Which means that probably your income is not what you are stating it is. Okay. Did you have regular defaults? Have you taken a lot of loans? Okay. So from CIBIL, you can get all this data. It also looks at stuff like what have you been saying on social media, your LinkedIn profile. Do you change jobs very regularly? All that tends to affect one's credit score. In market risk monitoring also, I said now sophisticated models are able to understand the factors affecting market risk a lot more, in a much deeper way. And in fact, these factors have now become much more global and complex than they were even 25 years back. So a lot of the boom in the Indian capital markets has been because of foreign funds coming in. And foreign funds have been coming in large numbers, have been gushing in because the Federal Reserve in the US had a very liberal monetary policy. But now inflation is increasing both in the US and in India, and people are a little apprehensive that the Fed is going to start tightening the, as it is called, the liquidity tap, which means it will be increasing interest rates, which are pretty much near zero in the US. This might affect the amount of funds that are coming into India. So, and it will hence have a depressing impact on the stock prices in India. So look how America's decision is going to impact how stock markets are doing in India and perhaps globally. So how to become a risk manager? Basically, a CFA, GARP, FRM or Premier qualification over a basic qualification, which could be an actuary or a CA or an MBA helps. In fact, for public sector banks, it is mandatory to have a GARP, FRM or a Premier qualification to become a chief risk officer. There was a finance ministry, government of India circular on this. A lot of risks are financial, so an understanding of finance obviously helps. So those of you who are doing your CFA, obviously, it would help to become a risk manager or to get into risk management. Just a quick thing here that you can, in fact, I'll probably deal with it in a subsequent point. So for insurance underwriting, which is deciding whether to give an insurance policy and what premium to charge for it, an actuarial qualification is very helpful, because what actuaries do is they are very good with understanding statistical data and applying it to various situations and then taking decisions based on that. So for example, if it's almost like a model saying that generally about, let's say 35% of people cross 65 years of age. But if you're a smoker, then only 25% cross 65 years of age. So that kind of insight is what an actuary comes out and says that how do I cover for that additional risk? And based on the number of policies that they're expected to sell, accordingly they allocate the additional premium that would be charged for smokers. Okay. So that kind of analysis an actuary is able to do. It's a very difficult 16-step exam, and they're quite, I'm told they're quite high in demand in the insurance industry. One thing to focus on is that while financial organizations, in that sense, have seen or have the most sophisticated risk management systems because of the very easy way that money comes in and goes, and because these organizations typically took very large and dynamic bets and they can go kaput very quickly. But other organizations also need risk managers. So I have a close friend who is the risk manager of ITC, and he has to deal with a very different set of problems. He has to deal with things like, for example, factory safety, for example, labor laws, disruptions, caused by technological change. Like, I think there was that whole vaping thing which had come in, and now, of course, it's got banned in India. I don't know how they managed it, but so there was technological change affecting even cigarettes. Okay, imports of foreign cigarettes coming into India, smuggling of cigarettes into India. So he has to deal with a different set of risks apart from the usual financial risks, which is their foreign exchange positions, investments, controls in their processes in terms of fraud, etc. So apart from that, he has to look at a different set of risk because it's an industrial organization. In hotels, you run a different set of risks altogether because you have all kinds of weird people coming into hotels who do their own activities. You could have people doing. A hotel is a place where politicians, criminals, they meet, in the garb of relative anonymity. So you can have illegal activities running in hotels, which they need to be careful about, because it will scare other genuine customers, and also it can lead to regulatory actions. So that kind of risk has to be managed and monitored and reported. Okay, so all organizations need risk management, but typically the most sophisticated risk management functions are found in financial organizations, which are these banks, NBFCs, investment managers, brokers, insurance companies. As I was saying, a good knowledge of statistics helps. All risk is ultimately probability. So it is, you deal with the probability of something occurring and the impact of that occurring. Ultimately, that is what risk is all about. And then when you deal with models, then you're talking about regression, which essentially is correlation of various factors to certain results. Okay. I spoke about the demand for home loans being related to the interest rates in the market. Now, what is the impact of 1% increase in interest rates on the demand for home loans is something that comes out with statistical regression based on past data. Increasingly, risk management is dependent on these models. So, a lot of people also come into risk management from stuff like data science. Some of them do financial engineering. There are these well-known financial engineering courses which are run in foreign universities. I have worked with risk managers, in my team who have done these courses in Britain and in the US. So most of the young people now can work with Excel macros and pivots to filter out data, to understand data better, to crunch the data. Of course, I am perhaps, I don't know whether I should say thankfully, a little old. So, I don't always need to, there should be some advantage of having white hair. So one of the advantages, you can have people do it for you rather than you having to do it everything yourself. it also helps to have a working knowledge of a programming language like R, which is used in analytics. In the fund management space, we use risk management tools which are available on the Bloomberg system and something called FactSet, which is used for risk management in the fund management industry. So if you have any exposure to these software as an intern or as a young person, then please do learn about them, how risk management is done using these tools, because it will stand you in good stead later on in life. I've spoken about operational risk. As I said, an understanding of the business and all the various operations, the systems that are there, the regulations, all that is important, and it will help you to manage operational risks better. I already spoke about a good understanding of the business, which is why a lot of the best risk managers actually don't start off or work only in risk management. They have some other experience which enriches their understanding of the business and of the processes. So they've probably worked in product management or operations or research, or if it's a broking business, then in the front office as a dealer, or in internal audit or finance. So typically, if you worked in these areas, then you understand what is happening in the operations of the business, and then, or how the business is being run. And then when you become a risk manager, you are able to do it much more effectively because you've actually done the work, and you don't have to hear from somebody who you don't understand how this is done. Because you can say, no, I do understand because I worked in operations and product management. In internal audit, the advantage is that you get a very good overview of the whole organization. It's, you worked with sales, you worked with finance, you worked with operations. If it's a financial organization, you work with the dealing team, with the front office team. So you have a good idea about all the areas. And then if you enter risk management, then you kind of, you can manage the risks relating to all the functions a lot better. There is a certain amount of forecasting that a risk management function entails. A really good risk manager should not only be able to tell you when things go wrong, but he should be able to anticipate when things are about to go wrong. So I think it's important to read the early warning signs. For example, bad employee feedback in the employee feedback survey. Now that means that A, you will have demotivated employees, B, you will have high attrition rates, C, you can actually have attempts at fraud and sabotage also. Okay, so I think one of the most important risk metrics which only a experienced risk manager will look at is the employee feedback survey. At least I look at it very carefully. And it is one of the early warning signs of an organization which will go through, which is probably headed for a certain amount of turbulence. Okay. The other is, of course, keeping up with the news on what is happening outside with the regulations, with technology, with competitors, and so that you can also advise frontline managers on what to do to prepare the organization better for these changes. A little bit about my career. I think Bihari Lal already has kind of taken you through it. I graduated from St. Xavier's College, Kolkata in 1995. Some of you would probably see that as ancient history. And then I qualified as a chartered accountant in 1998. I had a rank in my CA Inter. My first job was with TCS, and then I worked with Citibank in operations and controls. And then for 4 years as a domain consultant with Infosys Technologies on various projects in the financial services space. So see how I have done a bit of business analysis. I have worked basically in business analysis, I've understood processes, how to automate them. I worked in operation and controls, and then I did my FRM while I was with Infosys, and I was one of the early adopters of the FRM qualification in India, and perhaps globally, because at that time I remember, we were told that only 10,000 people globally have that qualification. After that, I worked in equity research for a startup for a short time, and then joined HSBC in 2008 as a product manager. Then my experience in capital markets, securities services, all that came together for my next role in HSBC, which is in risk policy and analytics. So it's an interesting story how I got hired into the risk management function. So I did have a slight advantage because I was an internal candidate. So what I did was, it was a role, it was a VP risk policy and analytics role. I realized that they were wanting at least 5 years of experience in risk management. And as you can see from the first 4 bullet points, I had no experience in risk management. So I prepared, I had a friend in the credit team. I asked him for the internal credit manuals of the bank. I went through all the RBI regulations. And finally, I went and they said, look, we've called you, but you really don't have any experience. And I said, okay, but I can read financial statements. I understand credit. I have been through all the RBI regulations. I have gone through your credit, manuals. Ask me anything that you would expect somebody here to know. And they asked me a couple of questions and hired me. So I think what impressed them was the fact that I was so well prepared. And of course, I also had an FRM qualification. So I told them that I understand all kinds of risk. It's not just credit, but also market and operational risk. Because as a product manager, I have experience of handling a product from start to finish. So setting up the processes, the controls, everything, and implementing them. And also with my FRM, I understand market risk management, treasury functions, how hedging works. So, I believe I can add value there too. And finally, they hired me into that role. It was a very interesting role where I had to work with the wholesale lending policies of the bank, which I aggregated from about 25 policies, which nobody ever read, to 8 logical policies. And I also had to create the MIS for the risk management committee, which was a pan-bank function because it dealt with retail lending, wholesale lending, treasury, operational risk, everything. In 2012, I put together all my capital markets experience in the past and my risk management experience to pitch for a CRO position at Nippon India Asset Management. And I did this role for 4 years. And for the last 4 years, 4.5 odd years, I've been with IIFL Wealth and Asset Management. So what I'm trying to say is my diverse experience has helped me to gain an understanding of different regulations and also to add value to my roles as a risk manager. Pretty much, I think we are close to the end of my presentation. One thing that Bihari Lal had told me was perhaps to talk some of the younger people here through the path that one would follow as a risk manager. Typically, you would want to understand better what is done in the various areas of risk management. As I said, I will again emphasize that risk managers the best risk managers have worked in different areas, and then they usually pitch for a risk management job. Typical roles are risk analyst, So that is when you are a generic risk manager. Of course, if you can be a specialist who's kind of only done that. So there, for example, if you're a model developer or a model validator, then you worked on that kind of model and you're a specialist in that model. So then typically you won't become a CRO, you'll work for a larger organization on more sophisticated models. Okay. You could also be a credit underwriter who is taking decisions on in a bank or in an NBFC to lend people or corporations money. You could be an insurance policy underwriter, which will typically need an actuarial qualification, as we discussed. You could be a market risk monitor. You could be an operational risk specialist, or you could be an information security specialist. These are typically the roles. In broking, in market risk monitor, you could have very different roles. In an asset management company, you will probably monitor limits and M2M positions. In a broking company, you will manage the margins and margin collateral and dealer level limits. Okay. So you could have very different roles in market risk monitor depending on the kind of organization you're working for. I kind of alluded to this earlier also, but every risk manager need not become a CRO. There are people who are specialists in these various areas of risk management, and they will rise in that area itself. Some people also move out of risk management into compliance, usually in addition to risk, because regulatory compliance is an important element of risk, or they move into internal audit. So there is always a lot of movement to and from internal audit from the risk management function. Some people work in forensics, some people go into research. Of course, there are the rare CROs who also move into general management or into fund management. Finance I've written because, for example, the ITC CRO that I was talking about is somebody who's spent all his life in finance, and he will probably move back into a finance role. So also, for example, the CRO of Infosys Limited, MD Ranganath, he became the CFO of Infosys later on. So people work in these because finance is a strong control aspect. So, and because risk managers also work with financial investments, etc. So there is a movement to and fro the finance function. So yes, so that's pretty much from my side. I hope this added value to to your understanding of what is risk management, what are the various things to be done in risk management, and what are the streams within risk management and the kind of career path that you can follow.
Thank you, Raghuvir. I think it was a very interesting session. There are obviously quite a few questions.
Right.
And a couple of them, obviously, there are people who are kind of good in IT, maybe in Java or big data or API. Where do you see that evolving? I mean, what's the relevance of AI, ML, data sciences? Where do you see that going with so many? I mean, you look at your broking world, right? I mean, there are these discount brokers who have sort of suddenly come from nowhere, and last 2 years obviously captured the market and left behind the traditional brokers. Where do you see the role of risk management vis-a-vis technology and innovation which is happening?
Yeah, so I'll start from the top, from Supratik's question. He has asked two interesting questions. One is the emergence of big data and APIs. Yeah, so a lot of analysis now, when I alluded to big data in my presentation, a lot of analysis now is using big data analytics. And essentially, for any good regression model, you would need a lot of data crunching. So that is being used. There are also systems which are being developed which are self-correcting or self-programming systems. Earlier we used to call them cybernetic systems. I don't know whether that expression is still used, but basically it's machine learning. So based on data, the system itself auto adjusts to what is acceptable or what is not acceptable, or it actually learns on the way. So I think that is something that is happening. So there is which is why programming and analytics is kind of getting closely integrated with risk management. You've spoken about open banking. I am not sure what the scope for that is in India. I wouldn't want to comment on it, but in India, I don't see regulators easing up much, because in fact they've tightened the screws around around the regulatory space. Fintech company, I think payment systems have kind of course, it's a very vibrant, it's a very vibrant area. And you have now small banks or payment banks, which are I think quite, so they are a lightly regulated area which has emerged. So, for example, Paytm Bank or recently the RBI clarified that Google Pay is not a bank, so people should be careful while using it. The rules which banks have to follow if payments don't go through. The RBI said we don't regulate Google Pay, so be careful, when you are using it. So I think that area is a little more is seeing some action. So, but not as much as the West. I think the RBI is a fairly cautious regulator. So, which is why it actually banned cryptocurrencies before the Supreme Court allowed it, saying that you can't just ban an asset class. But clearly, the RBI is not too gung ho about this kind of speculative currency.
Correct. So,
will pursuing actuarial science along with
good. There are some questions which are already.
Will pursuing actuarial Will pursuing actuarial science along with the CFA help in risk management career? Yes, of course, it will definitely help, because there is a lot of statistics that's there in the in the risk management space, and especially now with regression modeling, all that actuarial science. So you may not always work for an insurance company. You can actually work modeling data for a bank, but you are an actuary, which is why you know all the statistical tools, and then you are much better at programming than somebody else would be who hasn't done that kind of heavy duty statistics and mathematics. So the guy who teaches, the professor who teaches risk management at IMA has actually never worked as a risk manager. He's a brilliant statistician, Professor Arnab Laha. So he did his B stats from Indian Statistical Institute, Kolkata, then did his M stats, then went to the US to do his PhD in applied mathematics. Okay, so basically he's using those tools to find out, for example, probability changes, dependence of one factor on another, and come out with these very, very good models which can be used by others. And industry actually buys stuff from him because he's able to create these models which industry can pick off the shelf without developing it and use it for their own purposes. What leadership trait should, sorry.
No, yeah. So I just want to add one thing. You mentioned in your presentation that sometimes a lot of people work in non-risk areas before they move into risk, right? Like, for example, you had worked in equity research and then moved on to risk, and obviously you liked risk and you continue to be there. Yeah. What I wanted to understand was what happens post sort of people decide to move out of risk. Do people, I mean, you said finance function is one where people end up going.
Yeah. Yes.
But, do these risk guys make good fund managers or good investment guys, or, something else in terms of, like in private equity, you have a concept of operating partner where, they hire someone from the domain to run, the business. So if you are funding a consumer startup, maybe you will hire someone who has worked with an ITC or someone else for a long time to sort of head it. So where do the people from risk management go? I mean, apart from finance function.
So yeah, I mean, even some of the private equity funds have now started to hire risk managers, but typically they move into internal audit, back to internal audit. So you could move to a big four firm as a partner,
Consulting.
Or one step below that, maybe director. Okay, you could, or you could move into research. Very few people I know would, I think, have moved into active fund management. Generally, the research guys move into fund management, or they come into risk. But then it's a one-way traffic. I mean, you can move back into research, but very rarely would you become a fund manager.
Sure. And in terms of compliance versus risk, I mean, I do their logical extension of each other. But do they work parallel? Do people come in compliance before or then risk, or vice versa? I mean, a lot of functions, a lot of places I see, especially in smaller firms, there's only one function.
Yes.
Is compliant, audit, and risk, right?
Yes. Yes.
Where does the differentiating line comes?
Yeah, I think it is. You are right, completely right, that it is getting what's the right word? Integrated in many firms.
Sure.
So they have realized that it's a control function. So regulatory compliance is an important risk. So they have said that, okay, can I, so you will look at obviously the compliance aspects. And in a financial organization, a lot of the compliance relates to risk management. Sure. For example, your capital adequacy, single borrower limit, group borrower limit. These are ultimately risk management tools.
Sure. I have a very interesting question, which says, how is the risk manager's performance evaluated, captured, and appreciated appropriately as compared to a sales function?
Right.
And he's given an example. Let's say a risk manager of Nokia would have recommended adopting Android OS. May not have failed, and they would have never have known that scenario.
Right.
The risk manager would actually save the entire company. So, I mean, obviously, you talked a little bit about compensation, but anything on how the process works? How is it linked? Is it more, event driven? Is it more sort of industry driven? How does that work?
Like any other role, it depends on, I think, three main things. One is, how did that industry do? How did the company do? And lastly, how that person has done.
Sure.
So typically, for the person, it is important whether he has, what's the right word? Alerted the organization to possible issues. Okay. Whether he has provided the MIS with senior management required to be able to take decisions where they are managing risk. For example, I'll give you an example. Like when we went into remote working, okay, so because of the COVID thing, so I prepared a document on what are the controls that we have to compromise. For example, the dealing team would really not have any controls, right?
Yeah.
All the camera and recorded line, I'm not sure what will work.
Sure.
The second is, for example, we had a VPN, our VPN server, they call it a device in IT. I can only imagine what it looks like because I've never seen one. But that VPN device, we had only one device. So I said, if that fails, our whole, remote working thing will fail. So we quickly got a second device, which I think we rented out, so that we could move to the backup device when required. And then ultimately, we also, I think, if I remember correctly, we devised a load balancing formula whereby one device wouldn't be put into too much pressure. So we put both devices into operation instead of using one for the other. So this kind of alerting the organization to what can go wrong is a very important part of the risk manager's appraisal. That, I have told you that these things could go wrong, and which is why you took corrective action, and that those things have not gone wrong.
Right.
Okay. So I think that is important. And then there is stuff that, for example, the quality of discussions that have happened, whether, how the audit committee also has looked at stuff, whether you've closed all the points that were raised in internal audits.
Sure.
So all that I think is quite important. I saw an interesting question. I'll quickly run through the questions. BD,
Sure. There's one I think which came up recently, which is how does a typical day of a risk manager looks like? Is it kind of just waiting for the unknown to happen?
Right. That's a good question. So I'll quickly run through this in a minute or two. Where can I do risk management courses? There is GARP, FRM, and Premia. You can also do a CFA, which typically will cover a lot of the stuff, but it's kind of more focused on financial markets. Can FRM be clubbed with IT skills like Python, AIML? Yes, of course. But I have no idea where you can do these data science courses. So that you'll have to find out where you can do them. But these skills are very well recognized in the industry now. Okay. How much time on market risk? It will depend on the risk function and the nature of the organization, how much time the risk manager spends on market risk. Why is India not in compliance with Basel III framework? It is. So we have implemented the Basel III framework, to the best of my knowledge. The RBI independently implements it, right? So different countries implement different parts of the Basel III framework. And anyway, the Basel III framework is to be implemented in year by year. It's not that in the first year itself, you have to keep like 12% capital adequacy. Yes, somebody said taper tantrum. Yes, that's what's happening. Okay. Big data API, I'm already working in Java. Will pursuing actual science with CFA help in risk management career? Yes, it will. How difficult is for FRM? That's fine. Leadership traits for senior roles like CRO, obviously the ability to work with different teams. So a lot of the time the CRO or the, if he is also handling compliance, he is not doing things himself. He is stopping others from doing something or asking others to do something. And often that means being firm, holding the line. So I have people who tell me, please allow this. I have received money from a third party. Why can't we do this? Do you know how difficult it is to get that money? I have tried for 2 months. And you think for a moment, maybe I should just allow it. Poor fellow, he's really tried hard. And then you think, no, what if there is a show cause notice? He will also lose his job. I will also lose my job. So, he is now looking at just that one thing he's worked for 2 months, but he'll throw away a lot more if there is a regulatory notice for that action.
Not true.
So you kind of take that, bigger. How is risk management used in cryptocurrency? By staying away from it. Yeah. It's a very speculative asset, and I don't know how it works. So I personally am not a great fan of cryptocurrency.
No, thank you so much, Raghuvir, for the interesting Q&A session. As I look at the clock, I think
I will just answer that last question, BD.
Sure, go ahead.
Last question on how the typical day works. So a lot of the day, in fact, is around managing of exceptions. Typically, all exceptions, all tricky questions come to risk and compliance. I have a board resolution which is signed by somebody who is not a director. What do I do? Okay. I have a client who is, sorry, can you hear me? Yeah. I have a client who has an interesting background. E.g., he was a arms dealer. Okay. He never was imprisoned, but he's always there around every scam globally around arms dealing. Okay. So what do I do? So this kind of situation, you have to take the firm line and say, no, we can't go ahead with this. So a lot of the time is spent in explaining what to do or what not to do. Okay. Some of it is spent in MIS. Some of it is spent in coordinating for internal audit. Some of it is spent in following up for closure of points or in getting data for people for the MIS. So I think those are the typically main things that one works on. Sometimes one is talking to clients because if you have certain risk management processes which clients think are excessive, then you have to convince them why it's for their own good that you're doing it. For example, callbacks that we do for any kind of out of the ordinary transactions. Now, clients say, why do you have to keep calling me up for something that I've already sent you an email on? And we have to tell them that that's because emails get hacked and we're just trying to do a double verification. It's painful for us to do a callback, but we still do it because we don't want you to lose your money.
So as they say, all risk managers, may you live in interesting times.
Right.
I think each day that's how that day goes. But thank you so much for sharing your insights. As a reminder to our listeners, please do complete the evaluation survey, which has appeared on the screen at the end of the session. And you will find the link to the presentation in your chat box. CFA Institute and CFA Society members can claim professional learning credit by logging into their online professional learning tracking tool and recording it there. If you're not registered already, please do look out for our upcoming webinars on 22nd of July on practitioners' insights on rules-based asset allocation, and on 5th of August on CIO insights for analyzing the insurance sector. Thank you so much for participating in today's webinar from across the world, and thank you, Raghuvir, so much for being patient in taking all these questions. As always,
thank you.
Risk is out there.
Right. It was a privilege. Thank you very much.
Thank you.